Hi, it's Darren and welcome to my office. We're following the back to work protocols, so a couple of us can come in from time to time to do our work and get out of the work from home thing and, put some proper clothes on, although the building's still mostly empty. It's the end of September, and what I wanted to do today was take a little bit of time and go over something that's actually a really important celebration for us. At the end of the month, it's going to be the 1-year anniversary of our pooled fund that we launched last September. And as you know, our Canadian clients certainly know that we've been using our pooled fund pretty extensively in our registered accounts, RSPs and RIFs, where I don't have to worry about being tax sensitive. I can just manage the portfolio properly. And I'm going to put a link up here to kind of go over what the 4 components are to our pooled fund. We shot a little 2.5-3 minute video to give you an overview of the 4 key quadrants that make up both the balanced growth portfolio, which is the first one we launched, and our high income portfolio that we launched in July. They both have the same philosophy underpinning them, but they're different in terms of how I weight the different strategies and some of the securities I use to implement the different strategies. So today I wanted to go over kind of some of what we've done inside of the pooled fund over the last year, kind of what's worked, maybe what didn't work out as well as we thought, some of the changes I've been making, and also kind of what I'm thinking of as we go forward into the fall and into the winter time. So one of the first things that I did when we built the portfolio was take some of the models that we've used very successfully and brought them into the pooled fund. And remember, one of the reasons we built the pooled fund was so that I could decouple the portfolio from any individual account size. So in other words, obviously I can do more with a $20 million account than I can do with a $25,000 account. So the benefit of the pooled fund is that I can run a multi-million dollar, there's tens of millions of dollars in it, portfolio and be much more sophisticated, put more of our favorite things and our models into it, and be able to use it with greater application across all of our different accounts and make sure we can tie actually the planning work that Andrew and Vicky do better to the portfolio. So it gives us, I think, better care and control, more sophistication, allows us to trade more crisply. And I'm going to give you a couple of examples of where we were able to use that operational leverage to everybody's benefit. So let me kick it off with what some of the models were we first used to create as our foundation in the pool. So the first thing we did was we used a dividend growth model that we've been using very successfully. It's driven by the research teams at Raymond James in North America. We also put in one of my favorites, which is Darren's Dirty Dozen. Some of you are very familiar with that one, which was a portfolio I built many years ago. And obviously we've adapted it and adjusted it as we've been going. And the point of that one was to take what Warren Buffett's advice was, which is to invest in wonderful businesses. And he has a whole bunch of criteria for what a wonderful business is and what characteristics wonderful businesses share. And some of them I think are pretty obvious, but they're kind of fun to go over again. So things like they make a lot of money. Seems pretty obvious, right? They have fortress-like balance sheets. They make money in any economic environment. Indeed, they make money almost in spite of themselves. It's almost inevitable how they keep making money. Their businesses are so important. He also says that a great business has to be idiot-proof because at some point some idiot will run it. And what he means by that is that the business has to be so strong that it's almost impervious to crummy management, because every once in a while you get somebody in who doesn't seem to drive the car properly. So the company and the business has to be able to withstand those periods. It also has to be in a business where they have a moat around their business. So think of a castle with a moat around it. Very difficult for a new competitor to show up and start competing with you. So I followed some of those principles and a few others, and I built a model of 12 companies, and I thought they were kind of dirty because some of them were in businesses like tobacco and gaming and defense contractors and other things. We made it less dirty, and we added a non-smoking section a while ago. But that was kind of fun to play with that idea. Then I also realized that 12 was the wrong number, so we needed to make it 13. That just seemed to feel a bit better. So we made it a baker's dozen. When we moved that model, which has been very, very successful, when we moved that model into the pooled fund, I actually was able to expand it because I have more capital to work with. And we actually nicknamed it now Darren's Dirty 30. So we expanded that methodology up to 30 companies that I think are emblematic of what a wonderful business is. And we make sure it's diversified across sectors and it's all industry leaders. So that's also one that we put in, as I say, into the pooled fund. We've also added in some other components, and I want to give you an idea of what some of them were that worked out really well this year. So along with the Dirty Dozen and our dividend model, we also were able to sprinkle in some other ideas that really kind of captured what I'll call the pandemic trade for this year. So we put in things like Visa. When's the last time you touched cash? When do you think you'll touch a coin again? We've got this financial infrastructure that's getting nothing but more important for us to be able to maintain what we do. We also added in a couple of ETFs for very specific sectors like e-gaming, cybersecurity, healthcare. Those have actually done really, really well, because what's been interesting, and I'll put the video up here for the one I shot when I was in quarantine, that we're very much in a period which is reminiscent of the dot-com boom from 97 to 2000, where there's a bunch of reasons for it, but it seems like all the action is in one part of the casino. And so we want to capture some of that, but I'm going to cover in a minute where we've actually been paying attention to what else has been going on, because I learned the lessons from 97 to 2000, and I think we're going to repeat a lot of that. So, but we were able to get some of the stuff on the, as I say, the busy side of the casino right now. We also did well with some specialized lending strategies, one of which is in the media and film production, which has been an interesting one. We've actually done nicely with that. And you'll also remember from an update I did quite a while ago where I talked about the dislocations in the corporate bond market being interesting. We found a hedge fund manager to capitalize on, and I think he's done a really good job. So it didn't work out very well. Well, a couple of things that didn't work out very well. One of them was I made an allocation to energy, so oil and gas, back in the spring, or actually in the wintertime. And I thought that would actually work out well because the valuations were so low. But I think the headwinds for that space are actually increasing as opposed to decreasing, so I'm taking some of those back out now. The good news is that one of them was actually paying us about a 13 to 15% yield, so it acted as a bit of a parachute. But those, I think, as I say, we can go back to them at some point, but I think the headwinds are actually blowing stronger, not weaker. So we're just going to move off of that. I think I've been patient enough. What's also been interesting about what hasn't worked are actually some of the most successful investments we've made over the years. And again, I think this comes back to a bit of a popularity contest. And so, for example, I'll use the banks in Canada as an example of what have been kind of challenged this year. They're all down, and that's hurt our performance. But when I look at them, like most of them came down in the pandemic, and they're kind of fighting their way back up. But if you look at the dividends that the banks generate, historically, there's a very strong relationship between the income that we get off of a 10-year government bond, the yield we get off of a bond, and the yield we get off of the Canadian bank stocks. And it's always been really, really close. So for example, back in 1992, if we bought a Government of Canada bond and lent them money for a long time, we got about an 8% interest rate. At the same moment, if I went and bought TD Bank stock, for example, I got a little more than 8% as our dividend yield. And that makes sense, right? The bank has, because it's a business and it's not the government, it technically has more risk, so we should get a bit more reward. And if I look at all the banks in Canada over a long period of time, they have this really tight correlation between what the bond is paying and what they're yielding. So it's very, very close, except today. What we're getting today is a remarkable, I think, opportunity. And it's happening for a reason, and we'll talk about that. But what we're seeing today is if I loan the money to the Government of Canada for 10 years, we're only going to get, believe it or not, about 0.5% per year as our interest rate. That's it. If I turn around and I lend the money to, or I buy any of the Canadian banks, I'm going to get a yield somewhere between 4.5% to 5.5%. That's amazing. So that gap, 0.5% to 4.5% to 5.5%, I haven't done the homework, but I don't think it's ever been that wide before. I can't go back far enough in the charting systems to actually see if it was ever wider than that. So this is historic in my view. Why is it happening? Well, because I think a lot of people are concerned that the economic damage that's been created over the past 6 months because of the pandemic and the disruptions and the shutdowns are all going to hit the banks pretty hard. And that's true. I think that's why the bank stocks are where they are today. But we've also seen in their latest earnings reports that they're all paying their dividends and they've actually been still making money. I spent 20 years working for the Canadian banks. I'll tell you, they're really good at risk management. So I think on a risk-reward basis, that's actually really attractive. But on the other side of that, I want to talk about Tesla for a minute, because we actually made money on Tesla. But Tesla, back just a few weeks ago, this is how crazy the valuations have gone. So nobody wants to buy the banks, or real estate or a bunch of other things, but they do want to buy Tesla. And so just a few weeks ago, I read this. Tesla was worth more than the combined value of General Motors and Ford. But not just Ford and GM was worth more than, it was worth more than 4 times that. And yet sells about maybe 3% of the number of vehicles per year. That math doesn't work. Now, Tesla's actually an interesting example of something we did that worked out well. So back when the pandemic hit and the disruptions happened, we saw Tesla stock roll off pretty hard. I figure that a lot of people are going to be sitting at home in their basements working from home, but they'll also be watching CNBC and BNN Bloomberg and doing some trading. And Tesla's a very popular stock with novice do-it-yourself investors. So I said to Nick and Pedro, buy some Tesla in the pooled fund. Now, I would never do this in an individual client account because, first of all, the bet would be small because I don't want it to be enough to hurt us. So it would be almost a tiny allocation in anybody's account. But also, the risk level's too high. It was purely a speculation. But I do have room in the pooled fund to do those kinds of things. And if you watch the video that I put up about the overview of it, you'll see that there's an allocation in the pooled fund for what we call special situations. I wanted to call it when Darren sees $10 in the ground, he can pick it up, but no one would go for that. So we actually bought a bunch of Tesla in the pool. I was shocked that in less than 3 weeks it had doubled. Unbelievable. So in that case, Vegas rules apply. So I said to Pedro and Nick, take our original money off the table, take our chips off the table, put them in our pocket, and we'll play with the house's money now. It's doubled again. Unbelievable. So I'm going to let it ride because why not? It's kind of fun. We have our original money out. Everything that's there now is play money and is profit. We're watching the tech stocks come back down a little bit, but I think they might actually continue going on. But in the meantime, we're going to go back to our old favorites. So again, we have the banks. We have things that pay us lots of dividends. What's also interesting to me are some of the best investments I found after the global financial crisis back in 08 and 09, when they were also not in favor. But when I went and did my homework, I discovered that operationally their businesses were doing fantastic and nobody seemed to figure that out. And one of the things to know about investing is that you get your best returns from unanticipated surprises, unanticipated earnings, unanticipated revenue, when things are better than people think. It's impossible to make money when all the good news is baked in the cake, because all that can happen is you get disappointed. But the real opportunity is to go where other people don't seem to be paying attention. And I've used this quote from Warren Buffett before, where he says that in the short term, the market's a voting machine and it votes for what's popular. But in the long term, it's a weighing machine and it weighs value. So back in 08 and 09, I went and looked for companies, and I found companies and businesses and industries that were very unpopular, very out of favor. So things in like real estate, mortgage lending, stuff that, no, nobody wanted that. That's what caused the financial crisis. But we found investments that had performed really, really well, and guess what? They became some of the best investments we've ever bought for clients because we got them at the right time. Today I go and I look at our portfolio, and some of those long-term winners, they're actually out of favor right now, just as they were the last time. And they're hurting our performance in the short term, but I think they're actually the exact things we should be holding if we're going to be successful long-term investors. So it has been a bit of a mixed bag. Portfolios are always like that. There should always be kind of three things in any well-functioning, disciplined, diversified portfolio. There should be stuff in there you love, stuff in there that looks like it's half asleep, and a few things that feel like a rock in your shoe. If I have that experience, then I probably built it correctly, right? Because it has to always have that level of diversification. So what are we thinking about going forward? Well, I'm actually taking some of those energy trades that I'm exiting. I'm going to hold those in cash for a bit. I'm going to let some of the dividends and things accumulate and maybe run with a little bit more cash than I normally would. And there's two reasons. One is that we get a bit of a seasonality effect as we go into the fall. I think it's a bit of a self-fulfilling prophecy. I think most investors are of the view that September, October, historically the two worst months of the year. So people think they're going to be bad, so they move some to cash and they wind up creating the same thing that they were worried about. So I'm just going to play that game too a little bit, not a lot, just a little bit. But I also believe we're going to get into a really bonkers scenario with the U.S. election. We're already seeing that circus start accelerating. We have like just over a month until they go through their election. We're going to see the news cycles heat up, the debates heat up. My current favorite joke actually is that at the first debate, Trump's going to get up there and call everybody names. Biden's going to get up there and forget everybody's names. So this is just crazy. We will do a bit of an election special video as we get a bit closer. Not to call the election, but to give you the information and the evidence that actually it almost doesn't matter who wins. Building an investment strategy around who the president's going to be is a failed strategy, and we know that. We have lots of history that says you don't adjust your plans because of who you think is going to get in. And indeed, reflect back to when Trump won. You know, there were a lot of gurus that thought, you know, if Trump wins the election and becomes the president, it's going to be terrible for financial markets. Well, that was true for about 2 minutes at 3 o'clock in the morning, and then the market went straight up almost every day from the time he got elected until the pandemic hit. So if you'd had the view that Trump's going to be bad for the investments in the stock market and the equity markets, you got that one wrong. So I don't want to make any bets on who the president's going to be. What I do believe, actually, is that independent of who wins, I think it's really just going to be a question of who's got their foot on the gas pedal and how hard are they pressing. I still think we're going to be in, because of the pandemic and because we've got to get people comfortably, or at least somewhat, through the financial disruptions, you're going to continue to see accommodative fiscal policy, accommodative monetary policy. The spending is just going to keep coming, and it's just a question of how much and where. So we'll be following that. I'm also going to put up a link to one of the Walking with Charlies that I did, where I talked about the K-shaped recovery. And I think that provides a really good framework for how we're going to navigate through as we move from what I'll call the pandemic trade, which was, again, all the money on one side of the market. So anything with cloud computing, we did actually, Best Buy is another one we did well with, because I knew people had to run out and get monitors and headsets and those kinds of things. So the pandemic trade, now we've got to be thinking more about the reopening trade. What happens as things kind of begin to return to whatever the new normal is going to look like, and figuring that out's really, I think, the next thing we should be turning our time and attention to. So I'm going to close it off there. We have more work to do. Thank you for your time and attention. Thank you for participating with us. We're very excited. We're working on more innovations and more things to, I think, try to be a little better at what we do for you, and always value your input and insight to help do our jobs better for you. So thank you for your time and attention. Have a great day.